All right, let's talk about Karooooo, because we've got a classic market head-scratcher on our hands. The company just posted a fantastic Q3 earnings report. I mean, they beat expectations, they raised their guidance, everything you'd want to see. And what did the stock do? It tanked! So what in the world is going on here? Let's break it all down.
Here's how we're going to tackle this. First, we'll run through the numbers themselves, which, spoiler alert, were really strong. Then we'll get into the growth story management is telling. After that, we'll try to solve the puzzle of the market's weird reaction. And to wrap it all up, we'll give you our take, the next call, complete with a rating on the stock.
Okay, so first things first, the numbers. And let me be clear, on paper, this was a textbook A-plus quarter, the kind of report that should have sent the stock flying. For starters, top-line revenue was up a very healthy 22% year over year. That tells you the core business is expanding at a really nice clip. But this is what really gets you excited. Annual recurring revenue, or ARR, jumped 28%. Now you know, for a subscription business like Karooooo, ARR is the holy grail. It's that predictable, stable income. And a jump this big means their growth engine isn't just running, it's actually accelerating. And what's fueling that momentum? Well, a record number of new subscribers. We're talking a huge wave of new customers coming in the door, which is just a powerful sign that what they're doing on the ground is working. Big time.
So how did all this stack up against what Wall Street was looking for? It was a clean sweep. Karooooo beat the estimates on both revenue and earnings per share. There's no other way to put it. They just flat out over-delivered.
So the numbers were great. But what about the story from management? Well, if you can believe it, the narrative they painted on the earnings call was even more confident than the results themselves.
This quote right here, from their own presentation, really says it all. This is their entire message in a nutshell. They keep hammering this point home. This isn't growth at any cost. They're focused on that super rare combination of expanding like crazy while also being profitable.
So what's the actual plan? Management laid out 3 key things. First, keep accelerating that high-quality ARR. Second, you got to spend money to make money, so they're investing heavily in sales and distribution to grab market share. And third, they're focused on getting more revenue out of their existing customers by upselling them on higher-value products like video and the Cartrack tag. And you know, talk is cheap. But they backed it up. Management actually went and officially raised their financial guidance for the rest of the year. That's a huge signal to the market that they believe this strong performance is here to stay. And this is where the story takes a sharp left turn. You've got a clear beat, you've got accelerating growth, and you've got a guidance raise. That is the trifecta, the hat trick that should have sent this stock to the moon. But for Karooooo, it just didn't happen. This is the million-dollar question, isn't it? With all this amazing news on the table, how does the stock finish the day deep in the red? It just screams that there's a massive disconnect between the company's performance and the market's perception. And it was an absolutely wild day of trading for the stock. It opened up 8%. Everybody thought, here we go. But that pop was met with a tidal wave of selling that just crushed it all the way back down to a 3% loss by the closing bell. A classic and brutal pop and fade. So what gives? On the one hand, you have a management team that sounds like they're on top of the world, firing on all cylinders. And on the other hand, you have the market smashing the sell button. What could possibly be behind this bearish action? Well, there are a few things that might have spooked investors. You could have some simple profit taking, but it's probably deeper than that. The big concern seems to be the cost of this growth. A staggering 47% increase in sales spending. That's a number that makes people nervous about profitability. And for a global company like this, you always have the wild card of currency fluctuations in the background. So where does Karooooo go from here? Does the market wise up and get back to the strong fundamentals? Or do these concerns about spending win out? Let's get into our take. We've got a 2-part prediction for what happens next with Karooooo. One part is for the business itself, and the other is for the stock. First, we think the business momentum is absolutely real. That subscriber growth, the ARR acceleration, we expect that to continue. But, and this is a big but, that heavy spending on sales is not a one-time thing. We think margins are going to stay under pressure, and you can bet that's going to be the #1 thing the market is watching like a hawk in the next report. So what does that mean for the stock? Well, that leads to our second point. We think it's going to be stuck in a range. It's in this tug of war, right? The strong growth puts a floor under the stock, but the worries about spending create a ceiling. So it's basically stuck in limbo until the company can really prove that these big investments today are going to pay off with big profits tomorrow.
And because of this tug of war between growth and profitability, we are initiating our coverage of Karooooo with a market perform rating.
So to sum it all up, look, the bull case here is strong. The company is executing incredibly well. But the market is just completely fixated on the cost of that growth, and that's creating a major near-term headwind that we think caps the stock's upside, at least for now.
Karooooo is a truly compelling growth story, but the market is clearly demanding proof that it can be a profitable one too. So the big question for any investor now is this: do you believe today's big spending is a smart investment in tomorrow's profits, or is it just a costly gamble? And as always, a reminder, this is not financial advice.